see the headlines all the time, right? Like a local tech startup or, I don't know, a boutique agency
Yeah.
just posted $500,000 in quarterly revenue.
Oh, yeah.
Constantly.
And the immediate reaction is always the same. Like, they've made it. The machine is printing money.
Right. It is, it's the easiest trap to fall into, just assuming that top-line velocity equals actual business viability.
Exactly.
But, I mean, you take those exact same immaculate books, like $500,000 in pure revenue, and put them in front of a seasoned economist.
Yeah.
They might look at the founders and tell them they've actually made zero profit.
Which sounds completely wild. But welcome to this deep dive. Today, our mission is to, well, tear down the financial illusions that mask how money actually moves through an enterprise. Whether you are scaling a startup, analyzing a stock for your portfolio, or just want to understand the invisible levers of the market, we are going beyond the basics today.
We really are. We're unpacking that dangerous gap between revenue and cash flow, the reality of accrual accounting, and the fundamental shift between accounting profit and true economic profit.
And just to set the stage for you, the insights today are synthesized from a pretty rigorous stack of financial frameworks.
Yeah, we've got a lot of good stuff.
We are pulling from the FDIC's Small Business Financial Management Catalog and operational benchmarks from Shopify, Rippling, and the U.S. Chamber of Commerce.
Right, and we're also anchoring the discussion in some core economic theory from Wikipedia regarding market competition.
Exactly.
So let's jump right into the top-line illusion. The financial reporting from Rippling warns specifically about this state of false confidence.
False confidence, yeah. That plagues high-revenue businesses.
Right, and this usually stems from a failure to segment the different flavors of revenue. It is one thing to look at gross revenue, but the moment you start mixing, say, operating revenue with non-operating revenue, you are flying blind.
You're intentionally skewing the data at that point because operating revenue is the lifeblood. It proves your core business model actually works.
The day-to-day stuff.
Exactly. Like if you run a software company,
Yeah.
that is your subscription revenue. Non-operating revenue is, well, it's the noise.
Like what?
It's the interest earned on cash reserves or maybe the one-time injection from selling an old piece of company real estate.
Oh, I see.
Right. So if a business leverages a one-time asset sale to pad their quarterly top line,
To mask a decline in core subscriptions.
yes, the gross revenue looks stable, but the actual enterprise is in decay.
Wow, okay. The U.S. Chamber of Commerce has a really simple breakdown of how this plays out with actual profit.
Right. The bottom line.
Yeah. Say you bring in $500,000 in revenue and you have $400,000 in expenses. Your profit is $100,000. Simple.
Simple enough, yeah.
But if your expenses creep up to, say, $525,000,
Which happens all the time.
right, your revenue is still a massive $500,000, but you are operating at a $25,000 loss. Okay, let's unpack this.
Sure.
Because to me, it feels like revenue is almost a vanity metric, right? Like social media followers. Whereas profit is the actual engagement.
Oh, I like that analogy.
Thanks. But it brings up a paradox with venture capital. If we know top-line revenue can be manipulated, why do institutional investors and VCs still obsess over revenue growth rates?
Well, what's fascinating here is what revenue growth actually signals about market friction.
Okay, tell me more.
Top-line scale demonstrates undeniable market demand. It shows product-market fit. Investors operate on the premise that cost structures can be engineered later.
Ah, so you can fix the expenses.
Exactly. If a machine is generating massive demand but losing money, a private equity firm can step in, right? They automate payroll, they renegotiate supplier contracts, they optimize customer acquisition costs.
They algorithmically fix the expense problem.
Yeah, spot on. But what you cannot engineer is organic market demand. If the top line is stagnant, I mean, no amount of aggressive cost-cutting will turn it into a unicorn.
Right. You can fix a broken engine, but you can't magically synthesize the fuel.
That is a great way to put it.
Which brings us to the mechanics of tracking where that fuel is actually burning. The FDIC Financial Management Catalog lays out the foundational architecture for keeping score, and it starts with the absolute separation of church and state, which is never commingling personal and business funds.
Never. I mean, commingling pierces your corporate liability shield, but practically speaking, it just destroys your data integrity.
Right.
The FDIC framework demands monthly reconciliation and a strict protocol for owners' draws.
Meaning business expenses are cleared before the owner extracts any capital for themselves.
Precisely. Because without that hygiene, your financial statements are just fiction.
So let's talk about their statements, specifically the friction between the profit and loss statement, the P&L, and the cash flow projection.
Two very different beasts.
Totally. A P&L gives you the net profit over a period, right? Subtracting cost of goods sold and overhead from your net revenue.
Yep, that's the formula.
But I'll push back on the idea that a clean P&L means a healthy business.
Oh, absolutely.
Because if a company operates on accrual accounting, where you book the revenue the moment an invoice is sent, not when the cash actually clears, that P&L can be a dangerously deceiving document.
It happens constantly, especially in B2B enterprises. Your P&L shows $100,000 in net profit for the month because you closed 3 massive enterprise contracts.
Right, and your accountant is thrilled.
Thrilled, but those contracts have net 60 or net 90 payment terms. The cash hasn't materialized yet.
But your payroll obligations and your server costs.
And your lease, all due in 5 days. This is the classic liquidity trap.
Right.
A highly profitable company, on paper, can easily be forced into bankruptcy simply because of a timing mismatch between accounts receivable and accounts payable.
And this is where the cash flow projection becomes the antidote to that accrual illusion. I like to think of the cash flow projection as like a video,
Right.
while the balance sheet is just a photograph.
Oh, the video and photograph analogy captures the utility perfectly.
Right. The cash flow video tracks the literal physical movement of capital over time.
You can hit fast forward and spot the dips.
Yeah, you spot that week 3 liquidity valley where the inventory bill hits before the client checks clear. And you bridge the gap with a credit line.
While the balance sheet, on the other hand, just freezes time.
Right. It's a snapshot of your assets, liabilities, and equity at midnight on a Tuesday.
And that photograph dictates your strategic agility for tomorrow. Like, if your balance sheet is heavily leveraged, meaning your liabilities absolutely dwarf your equity,
Yeah.
you have 0 shock absorbers.
Even if cash flow is okay today.
Right. You might have positive cash flow today, but a sudden macroeconomic shift
Yeah.
or a supply chain disruption, it will break the company because there is no retained equity to absorb the blow.
Okay, so let's assume a business has mastered this architecture. The cash flow video is smooth, the balance sheet is well capitalized, and the P&L shows a robust net profit.
A dream scenario.
Right. But this brings us back to The Economist from our hook. You hand over these immaculate books, and The Economist declares the economic profit is absolutely 0.
0.0.
Let's unpack the paradigm shift between how an accountant and an economist measure the world based on the Wikipedia breakdown.
So accountants measure the visible world. They calculate profit by taking revenue and subtracting explicit costs.
Explicit costs being the tangible outflows, right? Like wire transfers for rent, payroll taxes, software licenses.
Exactly. If your revenue exceeds those explicit costs, you register an accounting profit.
It's simple enough.
But economists measure the invisible world. They subtract explicit costs, sure, but they also subtract implicit costs.
Which are the opportunity costs, right?
Yeah, the cost of deploying your capital and time into this specific venture instead of the next best alternative.
The sacrifices you made to sit in the CEO chair.
Precisely. Let's look at an example. Consider a senior structural engineer earning $200,000 a year who decides to start their own consulting firm.
Okay.
They take $150,000 out of an index fund, which was returning, say, 8% annually, to capitalize the business.
Got it.
At the end of year 1, the firm generates an accounting profit of $150,000. The accountant files the taxes and calls it a massive success.
Right, the business is in the black.
But the economist steps in. They subtract the explicit costs, but then they subtract the $200,000 foregone salary. Plus, the $12,000 in foregone market returns from the index fund.
Oh, wow.
Right? The economist looks at the founder and points out they operated at a massive economic loss. They literally destroyed personal wealth by starting the company.
Which introduces this wild concept of normal profit, because normal profit isn't a mediocre year, right? It is the specific threshold where your economic profit hits exactly 0.
It's exactly 0.
Yeah.
Your revenue perfectly covers your explicit operating costs plus your implicit opportunity costs.
But here's where it gets really interesting, and I have some pushback on this entire framework.
Lay on me.
If my economic profit is mathematically 0, what is the incentive to keep the doors open? Like, why wouldn't the rational actor just liquidate and go back to their corporate job?
Because 0 economic profit does not mean 0 accounting profit.
Right, right.
At 0 economic profit, you are whole. You are drawing a salary that perfectly matches your market value. Your invested capital is generating a return equal to the broader market, and your bills are paid.
So you're fine.
You're great. It is a state of total equilibrium. You stay in business because your resources are being utilized at their absolute highest and best use.
Oh, I see.
What zero economic profit signifies is just that there is no excess anomalous super profit being generated.
And if there were super profits, it would attract predators.
It acts like blood in the water. In a free market, outsized economic profits signal to other entrepreneurs and investors that there is an inefficiency to exploit.
So competitors flood the zone.
Right. They replicate your model and drive prices down until that super profit is completely eradicated, returning the market to that baseline of normal profit.
Which perfectly transitions into the brutal realities of market margins, because hitting even that normal profit equilibrium is incredibly difficult depending on your competitive landscape.
It really is.
If we look at the operational benchmarks from Homebase, you see massive variance. Well-run salons might operate on 15% net margins, but the restaurant sector, it's a bloodbath, hovering between 3 and 9%.
And the data from the Small Business Administration highlights why those margins are so fragile, particularly regarding the labor multiplier.
The labor multiplier.
Yeah. The baseline hourly wage is an illusion. When you aggregate payroll taxes, workers' comp, insurance, and benefits, the true cost of an employee is actually 1.25 to 1.4 times their base wage.
That is steep.
It is. In a sector like food and beverage, where labor routinely consumes 30 to 35% of gross revenue, a mere 2% fluctuation in labor costs can literally evaporate half of the net margin.
Wow. It illustrates perfectly what economic theory defines as a perfectly competitive market. A highly competitive market is essentially an arbitrage algorithm.
Yes, exactly.
Any innovation you introduce that generates a temporary economic profit is instantly detected by the market, replicated by new entrants with no barriers to entry, and the margins are just arbitraged away.
Until everyone is squeezed back down to baseline survival.
Right. Now contrast that algorithm with a monopoly or an oligopoly. Uncompetitive markets operate under entirely different physical laws.
Because they have engineered formidable barriers to entry.
Like what?
Well, this isn't just about having a cool brand. We are talking about proprietary patents, exclusive regulatory licenses, or just immense capital requirements to prevent anyone else from playing the game. If we connect this to the bigger picture, because they face no threat of new entrants arbitraging their margins, monopolies are not price takers. They are price setters.
Like a public beach versus a private island. On a public beach, anyone can set up a towel, so profits get squeezed as it gets crowded. But on a private island where you own the only ferry, you can charge whatever you want.
Exactly. But the mechanism behind how they set those prices is fascinating. It's a constant tug of war between two things, the output effect and the price effect.
Break that down for us.
When a monopoly models whether to produce and sell one additional unit of a product, they have to weigh those two forces. The output effect is straightforward. Selling one more unit brings in additional gross revenue.
Makes sense.
But the price effect is the friction. Because demand curves slope downward to induce the market to buy that extra unit, the monopoly actually has to lower the price.
Oh.
And crucially, they don't just lower the price for that one new customer, they have to lower the price across all units sold.
Oh. So the rational move for the price setter is to artificially constrict the supply.
You got it.
They sacrifice the output effect to prevent the price effect from eroding their margins. They keep the supply constrained, hold the prices artificially high, and generate massive, sustained economic profits that never get arbitraged away.
Well, at least until government antitrust regulators intervene.
Right, right. Which brings us to a critical strategic pivot. If you are currently grinding it out in a highly competitive market, suffering through those razor-thin margins, you have to build your own barriers to entry.
You need to develop proprietary tech or maybe acquire exclusive distribution rights. Or build a facility that gives you unmatched economies of scale.
But by definition, your tight margins mean you don't have the retained working capital to fund that expansion. You have to look outward.
You have to strategically allocate external capital, and the FDIC framework divides this financing into two instruments, debt and equity.
Okay, let's look at those.
Equity is permanent capital. You sell a fraction of the enterprise to an investor, or you inject your own savings. It sits on the balance sheet and doesn't demand a monthly interest payment.
And debt.
Debt is leverage. You borrow capital, and the cost of that leverage is the interest rate and, the strict repayment schedule.
And the FDIC outlines specific golden rules for deploying this leverage, starting with skin in the game, meaning lenders require the founder to risk their own equity first.
Right. But the most critical operational rule, and the one that bankrupts otherwise healthy companies when ignored, is the mandate to match sources and uses.
Matching sources and uses.
Yes, duration matching is the absolute cornerstone of corporate finance. You must align the lifespan of the liability with the useful life of the asset it finances.
So don't buy a building with a credit card.
Exactly. If a business finances a piece of heavy manufacturing equipment with a short-term variable rate credit facility, they have created a catastrophic duration mismatch.
Because the debt will mature way too fast.
Right. It demands a repayment years before the equipment had generated enough operational cash flow to cover the principal.
Yeah.
You finance current assets, like seasonal inventory, with short-term credit. You finance fixed assets with long-term fixed-rate loans.
So what does this all mean? Because it introduces a brutal catch-22 for early-stage ventures.
Oh, the ultimate catch-22.
The FDIC emphasizes that to earn the right to borrow, a firm needs to demonstrate historical profitability, strong credit, and solid cash flow.
Yep.
But startups inherently require the debt to build the machine that generates the profit in the first place. The lender demands proof the machine works before they provide the fuel to turn it on. How does a new business actually get off the ground?
That historical profitability requirement locks most startups out of traditional commercial lending entirely.
So what do?
The strategy relies heavily on the equity side at first. Sweat equity, specifically, where founders substitute capital with uncompensated labor just to conserve cash.
Working for free.
Basically, yeah.
Mm.
And when external leverage is absolutely necessary before a track record exists, the pivot is toward government-backed micro facilities like SBA microloans.
How big are those?
They average around $13,000.
Oh, so pretty small.
Yeah, these specific instruments are designed just to fund that initial proof-of-concept phase, allowing the firm to generate the necessary P&L history to eventually transition to traditional business term loans or lines of credit.
Man, the architecture of scaling an enterprise is unforgiving.
It's a gauntlet.
To synthesize the frameworks we have dismantled today, revenue is vanity, profit is sanity. Optimizing the top line is basically useless if you don't understand the mechanisms underneath it.
Completely.
By rigorously separating operating from non-operating revenue, utilizing the cash flow projection to survive the accrual accounting trap, and strategically matching the duration of your debt to your assets, you can keep your business in the black.
And beyond the accounting, true strategic clarity comes from understanding your implicit costs and recognizing whether your market structure allows you to ever achieve true economic profit.
The shift from viewing a business through the lens of a bookkeeper to the lens of an economist changes every strategic decision you make.
It changes everything. And as we consider the mechanics of setting prices and capturing profit, I want to leave you with one final concept from the Wikipedia source on market competition to chew on: consumer surplus.
Consumer surplus, which is the gap between the maximum price a customer is willing to pay and the actual price you clear the transaction at, right?
Precisely. If your product delivers so much value that a client would rationally pay $1,000 for it, but your pricing model only charges $600, that $400 gap is the consumer surplus.
And traditional aggressive profit maximization theory dictates that you are just leaving money on the table.
Right. They'd say you should raise the price, capture that $400, and convert it into immediate accounting profit.
But capturing all the surplus makes you incredibly vulnerable, doesn't it?
That's the secret.
Yeah.
It maximizes today's P&L, but it fundamentally weakens your moat. If you extract every single dollar of value from the transaction, you incentivize your customers to listen to competitors who might offer a slightly better deal. But if you intentionally leave a massive consumer surplus on the table, if your customers perpetually feel like they're getting a steal by doing business with you, you engineer a psychological barrier to entry.
Competitors will struggle to break your monopoly on that client's loyalty.
Exactly. It forces you to ask. Is allowing your customers to keep that surplus today the ultimate long-term strategy for guaranteeing your economic profit tomorrow?
That is a brilliant strategic tension to navigate. Something to really think about the next time you price a product, or the next time you see a competitor boasting about their massive top-line revenue. Thanks for joining us on this deep dive.